Welcome to our first class. Okay, I went through your study material.
Yes, sir.
Today, what we are going to do is, in the next 1 hour, we are going to have a broad overview of what this subject is all about, so that I will also have a little bit of interaction with you, so that I can understand how much of that you know, so that wherever it is required, I can go a little bit deeper to make you understand. Ultimately, the aim is to make you comfortable with the subject. Okay, so we are going to at least be there for 40 hours. Uh, if you see your subject, it is divided into 20 parts, but I'm not going to go deep into any of the parts right now because I'm going to give you a big picture. What is this management accounting is all about? And as we go, then if you have any questions at the end of the class, you can ask me. So we can, in case if the link is getting cut after 40 minutes, you can we can rejoin with the same link. Okay. So
Sure.
first of all, this management accounting, what is this? How it is different from the traditional financial accounting, or there is another concept called cost accounting. So how does this differ from the traditional financial accounting? The traditional financial accounting deals with historical information. It tells you what is the profit of the company and what is the financial position of the company. But what happens is, when it comes to management decision making, the financial accounting has got a very limited application. So the management needs certain information based on which they can make a decision. That is why the concept of management accounting has come. Management accounting provides the necessary data, but don't think that data is coming from some new source. It is coming from the same source, financial accounting source, but it is actually presented to the management in such a way so that the management will be in a position to take some decisions. It can be various decisions, and you look at the primary thing compared to the traditional financial accounting P&L and some reports in management accounting. I want to give you one example before I move into the topic wise this one. If your company has got some 5 different products, okay, now if you go to the audited P&L account, you will have only one sales and various costs, and accordingly you will have a profit numbers. You may have 20% profit, but you will not know between these 5 products which one is performing at what level. You will not know. So that is why what happens is, typically if you go to a company, you must have heard the word called profit center or cost center. So instead of putting all the cost into one bucket, which is what is being done in financial accounting, either in cost accounting or management accounting, what happens is there is something called cost center or profit centers. So what we do is we group the cost under various departments or under various profit centers. Why there is a profit center, cost center concept? I'll give you a typical example. If there is one product, if the company is dealing with the leather products, it will have a revenue as well as cost. Those type of centers are called as profit centers. But if there is a HR department, obviously HR department will not have any revenue. All that they will have is cost. That's why there is something called cost center. So management accounting is something at this point in time, if you know that it is information which is classified in a particular way so that the management can make a decision. Okay, one more thing what I'm going to do is, at the end of every meeting, I will also share the PowerPoint slides which I prepared so that it will be useful for you to go through. Whatever I teach today, you may suddenly have a question after a couple of days. That is fine, no problem. You can raise the question anytime. Now let's go into the slides which I prepared for the day. Let me start.
Just 1 second, Raj.
Yeah. Yes.
Yeah. Sorry, I just joined now.
Yeah. Yes,
Raj, can you hear me?
very much. Yes.
Yeah. Saravanan, hello.
Hello, sir. Good afternoon, sir.
Saravanan, how are you?
Fine, sir. How are you, sir? I just
Yeah.
spoke.
Yeah, I'm sorry, Saravanan, I'm joining late. I'm actually outside, I am driving. So anyway, I'm just going to be listening in on the conversation. Raj Shekhar has already introduced himself, I think. So I won't delay the progression of the class. I will switch back to Raj Shekhar to continue. Raj?
Yeah.
Yes,
Okay. Saravanan, are you able to see the PowerPoint slide?
sir. Just a minute, sir. Just a small doubt, sir.
Go ahead.
I mean, I'm sorry, I shouldn't be asking this right now, but am I expected to wear some formal clothes and attend the classes and stuff?
Nothing. No, not at all.
No, I have student is wearing a t-shirt and you've been like wearing lots of formal shirt.
No, it is because Raj Shekhar wants to have the feeling of being the master. That's
No,
why
it
he
is
is
just
wearing.
it is just every individual's choice. That's all. Nothing.
Okay.
There is no such hard and fast rule.
No,
Yes, correct. If you see me, I am wearing an ordinary shirt like you. So don't worry.
yeah, it's just not meant to any disrespect. It's just that I'm here at my home. And
No problem at all.
It is just my choice. I want to, whenever I do anything like this, I want to do it in this way. That's all.
Yes,
I don't know whether it is in the current days, whether it is the right thing or relevant anymore. I don't know, but this is how I've been probably trained in that way.
Yes, sir.
Okay. Okay, let's continue. Now, what are these 20 lessons which we are going to talk today? You are going to get a clear picture. But one thing I'll tell you, even if you don't understand any component of this one, from tomorrow onwards, we are going to have a lecture on each individual topics. If you see, there are 20 lessons are there, approximately about each lesson 10 to 12 pages. Your book itself is about 240 pages, correct? So that's not a problem. Okay, now let's go to the first part of your, this is a broad overview class where you have the first part. Among 20 lectures, I have put the first 10 lectures. These are the things we are going to deal with. What is management accounting and what is its strategic context? So that is the first lesson which probably we will be covering tomorrow. Then there are some different methods of allocating the cost. There is something called full absorption costing methods, which we will see in the second lesson. Now, before even going into the third one, I want to tell you this management accounting and managing the business in a very strategic way. What is that? You will get to know, but there are a lot of similarity or relevance on how management accounting can be used to strategically manage a company. So that is what we will see in chapter 1. Now, there are some different costing methods are there. There is something called job costing and there is something called process costing. So process costing and capacity management is the main topic in chapter 3. Then we have activity based costing and then we have activity based management. Chapter 6 and 7 are dedicated to another topic which is called as marginal costing. The other word for marginal costing is cost volume profit analysis. Then whenever any decision has to be made by the top management, what are the relevant information in a decision making? That we will cover it in chapter 8. So then I go to chapter 9. More often what will happen is whenever a decision is made, it is not going to be easy all the time. Sometimes a company may be faced with some difficulty. Instead of using the word difficulty in management accounting parlance, this is used as constraints, and there are some uncertainty. What is this constraint, uncertainty? I will explain in detail. Then, how can we use management accounting for the purpose of pricing? I don't know whether you have worked in some companies. In real life, what happens is the pricing decision of many managing directors who are the decision makers in a company, they are actually made in a very emotional way without actually having relevance to their cost structure. So they may be taking a particular work at a very low price as they want to beat the competition. But in reality, what happens is the best way to do the pricing is to have your data ready and then make sure that how much profit margin you want to have over and above that. That's how the pricing is done. As you go along, you will also know something. There is something called target pricing. We will see one by one. Now, I only gave you an introduction to these 10 topics. So nothing to worry. We will go into this detail a little bit more. Okay. Now, let me go one by one to these topics. The first one is management accounting and its strategic context. Let's see in one slide what is that chapter 1 is going to tell you. In this chapter, the first thing you will understand is what is financial accounting and how management accounting is different from financial accounting, and what are the differences between financial versus management versus cost accounting. Now, what is the main purpose of having a management accounting? What does it do? The main thing is at a very product level or division level or vertical level, it keeps the scorekeeping, management accounting. Then what happens is if anything goes wrong in any one of the divisions, then management accounting is useful to draw the attention of the top management. Then it is also used for problem solving. So these are the main 3 functions of management accounting. So what are the different steps in which a decision is made? How planning is done? How control is ensured in a company? That is another aspect which is covered in chapter 1. So, as you know, in the last 10-15 years, a lot of things have changed. The way people work also has changed. Suppose if you learn, if you would have listened to a management accounting class some 20 years back, as compared to a management accounting in today's parlance, there is a lot of difference. There is a lot of impact because of the digital automation. Sometimes they talk about big data analytics. They talk about robotics. So all these things have a significant impact on the management accounting. What is it we are going to see that is covered in the impact? Then, if a company has to succeed in a strategic way, how management accounting is important for that. Then we will talk about value chain, then supply chain, key success factors for company, why continuous improvement and benchmarking are important, and how a management accountant helps the decision making process. And there are certain terms like cost center, profit center, sunk cost, all these things, basic terms are covered in chapter 1. Saravanan?
Yes, sir.
Are you comfortable? Or I will share this PowerPoint slide also. Are you comfortable?
Yeah, I'm comfortable, sir.
I'm talking only about the various components of chapter 1. Now let me move on to chapter 2, because from tomorrow onwards we will go chapter wise in depth. But today's class is kind of an overview. In chapter 2, wherever you have any issue, you can pause and then ask me a question. Okay. In chapter 2, broadly, the main focus of chapter 2 is absorption costing methods. Why should there be something called absorption costing methods? I want to tell you upfront that whenever a cost is incurred in a company, there are certain costs which can be easily identified to a particular profit center or to a particular cost center. And also, on the other hand, there are certain costs which are not directly identifiable. I'll give you an example. Every company will have finance department, HR department. There may be some 4 or 5 operating departments which are working. You cannot put the cost of finance department or cost of HR department just like that into any one department, because these are common costs. Whenever there is a common costs are there, then we need to find out how we can allocate so that these costs can be absorbed, because ultimately whenever you have 5 cost centers and 5 profit centers, the cost centers accumulated costs need to be reallocated and the same needs to be absorbed by the profit centers. So that being said, there is a need for absorption costing. How do you do the absorption costing? Whether you do it on a fixed rate or whether you do it on a departmental overhead rate, these are certain things which are dealt with at length in second chapter. Now that actually takes you to a next level. There is something called activity based costing, which will be covered in the future. Okay, what is a job costing or what is a batch costing techniques? The job costing techniques, normally what happens is in a company like construction industry, where the company operates with some 7 or 8 projects, each are significantly bigger. Now what happens is normally the costs are accumulated against each of the projects. So their job costing will be a much better way to control or monitor the cost. The batch costing is something in a manufacturing environment, more often it is used. So as I told you, overhead absorption can be based on departmental rates or different rates. We are going to talk about our blanket rate. We are going to talk about all those things. So the first chapter, you have to understand how management accounting is strategically important. In the second chapter, how the cost absorption can be done for various costs which are incurred, more particularly for the common cost. So what do we do in the third chapter? Okay, now we talked about job costing, we talked about batch costing, and there is something called process costing. Can you imagine where process costing will be more relevant? Saravanan, can you give an example in which type of company process costing is more commonly followed?
Manufacturing industry, sir.
Manufacturing industry. You're right. See, what happens is in a process costing, okay, let's assume a real estate company, they are building some 1,000 flats in 10 different locations. On an average, there are 100 flats in each location. Now, their job costing is the most appropriate because there's going to be 10 locations, geographical locations. Each one is having 100 apartments. You want to know that project 4, how much is the revenue it is generating? Project 4, how much cost we are incurring? So we would like to know what is the profit ultimately which is happening. So that is job costing. Whereas in the case of process costing, now let me take an example. You rightly said process costing is more relevant in an environment where manufacturing is happening. Okay, let's take a common example of the bathing soap, hammam soap. Now, do you want to monitor the cost at each individual hammam soap level? No, we don't want to do that. Why did you want to do for each geographical location for a real estate company? Because each one of them are almost 10% of the company's operation. Whereas a soap manufacturing company may be manufacturing 1 million soaps every week. When you are going to manufacture 1 million soaps every week, you don't need to control the cost at each individual soap level. Instead, there is something called process costing. That means process costing, how it works is, okay, now what happens is the soap manufacturing, this goes through some 3 or 4 manufacturing processes. Now, whenever a batch of 200 soaps, that is output, if it is there at the end of the month, let's say in department A where manufacturing is happening, 200 units, equivalent units, if it is 50% complete, we will take it as 100 soaps have been completed. something like that, we arrive at an equivalent unit. That's how we value the work in progress at the end of the month. So it is a batch of 200, the work completed is 50%, then we take a equivalent unit of 100 units. That's how we arrive at the cost per unit, and we go on. Then in some industry, we also use something, we talked about job costing, batch costing, and process costing. There are some companies where we have to use hybrid costing. What is this hybrid costing? Where the facility handles groups of products in batches and also charges the cost of materials to those batches, while also accumulating labor and overhead costs to the departmental level. See, what happens is, in a soap manufacturing unit, the material cost, labor cost, and all are done through process costing technique, whereas the other overheads, which are common overheads, they are done in a different method. So what essentially I'm trying to say here is, it is not necessary that you have to follow one costing system. You may at times follow two different costing systems. It again depends upon the convenience and the suitable application for a particular event. In chapter 4, we are going to talk about activity-based costing. What is this activity-based costing? Now, very simply, let's assume you are a manager of a particular department. You have a uniform machine. If I may give you an example, you have a lathe, okay? You operate with 5 lathes in your department. So naturally, your department has got certain amount of cost. There are materials which comes for some machining in your department. So 1 hour of your time or your department's time, suppose if the process takes 1 hour, you may like to charge that particular based on, so it again depends upon what is your monthly cost divided by the monthly operating hours. So here in activity based costing, what we do is, we exactly take the total cost and divide by the total number of hours that particular machine is operating. Probably your machine may be operating for 500 hours in a month. With 4 lathes, you have 2000 lathe hours. So depending upon that, your department cost is divided with a denominator of 2000 to arrive at a per hour cost. So something like that is done in activity based costing. So the primary focus of activity based costing is, depending upon the activity which happens in a particular department, the costs are allocated or passed on to whoever is going to use that particular department. There is something called product cost subsidization. What is this? Now, I want to give you an example for the first one. Whenever you have a scenario, let's assume I am a company already having 4 products. Now, I introduced a 5th product. In those 4 products, I am well established. I operate with more than 20% gross margin, but I have developed a new product, 5th product. When I developed the new product, it comes with a huge amount of R&D cost, huge amount of fixed cost. But because that product is new in the market, I have to penetrate that into the particular market. Even though the records show the cost of that particular 5th product is itself 100, so I should be selling it at 120 or 130. But in order to penetrate the product into the market, I may choose to sell it for 100 or sometimes even at 90 at a loss. So that what happens is, I want customers to buy that product. Once the customers buy the product, once it is in their hands, then I will be able to increase the price. So what is that I'm doing? The first 4 products profitability or margin, I'm reducing it by subsidizing at a lower price of the 5th product. So we will go into all these things in a little bit more detail. Based on activity based costing, there is another concept which has emerged, which is called as activity based management. So here what we do is, we use the data or activity based costing data for managerial decision making purposes. Sometimes even make or buy decisions also are made. Do you need to have 5 lathes within the company and incur $20 for that particular 1 hour? Or if somebody is able to produce the same thing at $15 elsewhere, you can go to that particular person. Why do you have to run a department and charge everybody who comes to your department at $20? when the same service is easily available at the same quality elsewhere at $15. These decisions can be made based on activity. This activity-based management is a concept which has come based on activity-based costing. Now we are coming to this particular area. The chapter 6 and 7 is going to talk heavily on marginal costing. Marginal costing is again a very simple and important area. Now here we talk about the main concept in marginal costing or CVP analysis is the costs are classified into two categories. The first one is called as variable cost. Then the second one is called as fixed cost. The word fixed cost itself means that whether you have a zero output or whether you have 100% capacity utilization, the fixed costs are going to be incurred no matter what. So the most important thing is when we are going to increase your volume, when you are going to already at 80% capacity, as long as you sell your products higher than your variable cost, still you will make money for the company. You know what? Let's assume your variable cost, okay, your domestic price is, let's say, $100. Your variable costs are $60. Now what is happening is there's something called contribution. For every unit sold, you contribute $40 to the kitty. Now you are operating at 80% capacity. What does that mean? That the company still has 20% capacity to produce. Now this is a typical sum which will come is, okay, your selling price is $100, your variable cost is only $60. There are some fixed costs. You don't have to bother in CVP because the fixed cost will be anyway incurred whether you operate at 60%, 80% or 100% capacity level. Suddenly if some export order comes to you, in order to fill in the 20% capacity gap, where you can put the plant to a better utilization, and if they only offer a price of 90, will you accept it when the variable cost is only 60? Saravanan?
Sir,
the normal selling price in the domestic market is $100 with a variable cost of $60, and I operate at an 80% capacity level and a new order has come, but that guy says I will only pay $90. Is it, if you're a management accountant or if you're a managing director, will you accept that order or not?
If it's greater than, if the price is greater than my variable costs, I will accept the order.
Excellent. Why? Because your fixed cost is not at all relevant for this particular decision making. Why? Fixed cost is like a flat line in a graph. It is going to remain. Even if you produce zero, your fixed cost is going to be fixed cost. But if you produce only zero, your variable cost will be zero. That's why the variable cost is like that. So you are very, I just wanted to see whether you are just following whatever I'm saying. Okay, now tell me one thing. What do you mean by break-even point?
So break-even point is when my revenues meet my costs. No profit.
Let me put it this way. Let's assume I have a, I'm not going into the numbers. My fixed cost is 40,000. Okay. I sell 100,000 and my variable costs are 60,000. I already told you my fixed cost is 40,000. So in this scenario, in CVP format, you take the sales of 100,000, you subtract 60,000 variable cost. The next item is called as contribution. So contribution is 40,000 and your fixed cost is 40,000. In a very crude way, I can say at a company level, whenever the fixed cost and the contribution matches, that is a point, it is called as break-even point. Okay. So ideally what I should do, I should have 200,000 as my sale and 100,000 as my variable cost, 100,000 as my contribution, 40,000 as my fixed cost, and 60,000 as my net profit. This is how I do. So as you rightly said, break-even point is something where your contribution exactly equals the fixed cost. Okay, fine. We will dwell about these things at length. Okay.
Sir,
Then,
a lot of these
yes.
things, I think I've done it before in economics and management accounting portion last year when we had.
Yeah. Okay.
So
Okay.
I'm a bit familiar with stuff.
No. The reason why I am asking is I also want to know, because whatever I say, it should not be some. The main purpose is it should make sense to you. That's why I wanted to check. Okay. Then, how do we apply the cost volume or marginal costing techniques to support some strategic decisions? We made a strategic decision just now whether to accept a export order at 90 when your variable cost is 160. Somebody may ask, why should you sell it at 90? We can do as long as you are going to make sell it at a price which is higher than your variable cost. Saravanan, will you sell below your variable cost?
Sir, I'll be making a loss.
Excellent. Very good. Okay. So then we move on. The relevant information for decision making. What are the information? Suppose if you are sitting in a boardroom, you want to make a decision whether I should, let's assume you are working in Ford Motor Company, and Ford Motor Company has got a capability of producing their own power steering gears. Should they make the power steering gears internally at $1,500 per unit, or can they outsource it for $1,200 from an outside automobile ancillary producer? So this is a special pricing decision. Now, remember one thing. If Ford Motor Company manufactures power steering gears at $1,500, and if it is A-class quality, if you are going to procure something for $1,200 instead of producing it internally, and if it is coming at a third-rate quality, now remember one thing. Tomorrow when you are going to sell this car, if the power steering gear fails, nobody is going to go to that automobile ancillary company. Hey, why did you produce a power steering gear which is not even good enough for 6 months? Nobody is going to go after that. So who will be held responsible? The Ford Motor Company. Suppose if I am driving a Ford motor, my power steering gear fails, I will go to Ford Motor Company and I will vent all my anger on him. So make or buy decisions are not only based on just the numbers. When I manufacture this, it makes I have to pay $1,500. Why not I buy it for $1,200? What you have to ensure is whenever you are buying, taking such decisions, the quality should not be compromised. That is what is the most important thing. These are certain information which you need, which you are going to use in a decision making process. Moving on further is this is a very important chapter. Theory of constraints. What is happening is I may have product A, I may have product B, I may have product C. Now remember, all three are well accepted in the market and there is a certain amount of demand is there. Let me put some numbers. Product A, I can easily sell every month some 200 units. Product B, I can sell 300 units. Product C, I can sell some 200 units. So 200, 300, 200. So totally there are 700 units. 200 plus 300 plus 200 I can sell in the market. Now what is happening is, yeah, that's the ideal scenario. Naturally, you will produce the same number and then sell it. But there is a constraint in my company. What is happening is, for producing 200 of A, 300 of B, and 200 of C, I require 1000 machine hours of a particular machine. But unfortunately, in that particular department, there were three machines were there. But right now in this month, only 2 machines are there. When the third machine was running, each machine can run for 400 hours. So 1200 hours was available. But how much I require for this particular thing? I need 1000. But unfortunately, one machinery is not working. So essentially, for producing 200 plus 300 plus 200, I require 1000 hours. But because only 2 machines are working, I only have 800 hours. Are you able to see the problem? This is a theory of constraint. I am constrained by less machine hours of that particular department. So should I go with product A, B, and C in the sequence, How do I make such a decision?
So for this, you basically like take whichever product gives you the highest contribution, you produce that first, and then the second one, like basically what gives you the most revenue, you should prioritize that, and then like it
I
should be
would give
managed.
you, I would give you 50% mark. You know what? This is what I used to think first when I was a young student. It is depending upon whichever product A, product B, product C, whichever is giving a higher contribution, you should prioritize. It is not that way. You know what you should do? Whenever there is a theory of constraint, product A may use 3 hours of that particular machine, which is constrained. Product B may use 4 hours. Product C may use 2 hours. So you take the contribution per hour of that particular machine. Correct?
Yeah. Contribution per, sir, I wanted to tell that. That's what I wanted to say. Contribution per unit of the constraint.
Constrained resource. Constrained resource. Very good.
Yeah. I mean, I know that.
Yeah. Okay. Interesting. So these are certain things which we are going to talk at length in theory of constraints. Then there is something called queuing theory. I don't want to go into the details right now in the first class itself. Then there is in a queuing theory, we talk about maxi, max, min, maxi, min and all that. The most important thing is, look at it this way. Management accounting can be used as a very effective tool for pricing. And if you do a pricing, there won't be unnecessary surprises and all that. So pricing, the best way is to come with your cost structure. Okay, now the second part of that, your lectures, they are going to be lesson 11 to 20. Now we have something called target costing. How do we do long-term decision making? Then we have budgeting and control. There is something called strategic budgeting and control. Then we have this variance analysis. Variance analysis again is an important topic. I will want to ask you something when I come to that. The divisional performance, or divisional performance is something like the financial P&L. You break it down into vertical wise. There may be a company which is working, let's say they may have a construction division, they may have a leather division, they may have a glass factory. So obviously you would like to see how these individual divisions are performing. Then there is a transfer pricing, which is a very important topic. There are various methods in which transfer pricing happens when the product of one department becomes a input for another department. There's something called compared uncontrolled price method, cost plus margin method. These are certain things we are going to learn in chapter 17. Then strategic performance management. How do we use some non-financial performance measures? Then cost management, environment. Then what are the future trends in the current scenario? Okay, before we go in, there is a 3-minute time left. We will rejoin the call and I will complete this quick overview of 11 to 20. And I think it may take about 1 hour, 10 minutes, maybe 10 minutes extra. Okay, first of all, tell me what is target costing? Saravanan, do you have any idea what is target costing? In 2 or 3 sentences?
Not really, sir.
Okay. I will tell you what is target costing. See, I talked about just about 5 minutes back. I said you have to use your cost as a basis to arrive at your pricing. This is what I said. Okay. If I am producing a particular, let's say I am producing a calculator at 80 rupees, small calculator, and I want to sell it for 100 rupees with a margin of some 20% or whatever. This is a simple way, but this doesn't work in that way in target costing. In target costing, what happens is, let's assume I have 10 competitors. If the 10 competitors are already selling the same calculator which I am producing at a price of 75, what is the point in me entering into the market and quoting a price of 100? I think fundamentally there is something wrong. I may not succeed. because my cost structure shows my cost is 80 and I want to sell it theoretically at 100. But when the market is flooded with so many competitors who are able to sell it at 75, can I sell it at 75? Yeah, you can do it. Produce it at 80 and sell it at 75. You will not be in the business after 2 years because you are going to incur a loss. So target costing is something you first look at the price, which market, it's something called market ruling price. Market ruling price is 75. So you work backwards and then make sure that you are able to produce the same calculator at 60 or 62 or 63 or even 65. If you are not able to do that, then it is not the right business for you. Target costing is something where you start from you don't start from your cost. You start from the price at which this particular product is being sold in the market. There's less than 1 minute. We are going to anyway rejoin when the call gets disconnected. Then this is how. Okay, let's go into that particular target costing. So changes to the business and technological environment which have led to customer focus, shorter product life cycles. These are other things we are going to talk. I already gave you an idea about target costing. Then value added and non-value added activities. There are some very high technology. How you benchmark your performance with other companies are the best practices. Business process engineering. Okay, all big automobile companies like Ford Motor, they don't carry the inventory in their stores. They follow something called just in time. Then there's something called lean accounting. Then
so that I get a hang of what is the level at which you are at, and I think that's one of the reasons Raj was also trying to understand how much of it that you already know and how much we can build on.
Yes, ma'am. Sure.
Okay. Raj, carry on. We just got acquainted.
Yeah, very good. Yeah. Okay, so chapter 11 is again a very interesting chapter. Then we move on to chapter 12. Okay, here some long-term decision making, capital budgeting. I'm sure you must have heard about net present value, internal rate of return, payback period method, life cycle budgeting. These life cycle budgeting and costing are all done in, I have worked in a pharma industry where these things are done. What normally happens in a pharma industry is, again, there are two types of pharma industries are there. The first pharma industry is someone who invests heavily on the research in terms of developing a new drug. There are second type of pharma companies are there. Someone else has already got a FDA approval. Someone has incurred all the money in drug research. These guys will only produce based on the formula. If they are asked to produce some 10 million paracetamol, they will produce. That is the second category of companies. So this life cycle costing in the first category, what happens is you need to have a deep pocket to be in the drug research because it requires probably you may be working on some 3 or 4 molecules. You may have to incur some millions of dollars in each one. Only one of them will succeed. But remember that one drug which succeeds in a pure research in a pharma company will take care of the expenditure you have incurred from 4 or 5 projects. 3 of them might have failed, no problem, but still you will make the money. But what happens is the costing or management accounting. Okay, let's assume if Saravanan is sitting as a management accountant in a pharma company, which is focusing on their own research. For example, now COVID-19 is there. Now there are many ways. Okay, I don't mind. I'm ready to go for the next 2 years without any sales. But you know what? I'm going to bring all the best guys in the world to make sure that I develop and invent a drug and get it approved by FDA, and I will be able to commercially exploit it for the next 10 years. Now the product life cycle is coming now. So I'm talking about a period of 12 years. The first 2 years, a pure drug research company focused on that will only incur cost. After the end of the second year, there will be only negative retained earnings at the end of the second year. But they are looking at the big picture. What is the big picture? At the beginning of the third year, when their drug is going to succeed, then what happens is you will not have any big costs. Whatever cost you have accumulated in the first 2 years are going to be spread out for the next 10 years when the commercial production is going to start. These are certain things you have to keep in your mind. Same way, if Saravanan is going to sit in a company, oh, these are all high risk game, I don't want to do any risk, I don't want to do any research, all that I want to do is, I will take it like a contract manufacturing for other pharma companies. Whatever other companies have developed a formula, all that I will do is, I will produce it. From day one, you will have revenue, you will have cost. That is a much safer route. But again, it depends upon the entrepreneurs. So product life cycle costing differs in these two industries. So then you have something called strategic budgeting, and how do we control, what are the benefits and limitations. Already you may be having an idea, obviously, how to prepare a budget. First thing is you have to sit with the concerned people who are in charge for generating the revenue for the company. Somebody like a sales director, marketing directors, and you have to sit with them. For example, suppose if you are working for Hyundai Automobile Company, okay, either in India or in Korea, you may be already having some 20 different models. Now, I'm somewhere in the month of November, want to prepare a budget for the next year starting from January to December. In November, number one is, I will look at these 20 models. Then the sales director will say, Arshekaran, out of these 24 models, we are going to discontinue. There may be no sales beyond April next year for these models. Oh, is it? That means you are going to operate with only 16 models? No, we are going to launch another 5 new models. So this is the kind of scenario when you sit and prepare the budget. There may be some models which the management will discontinue. There may be some new models which will be coming in. All these things have to be, these are all company strategies. All these company strategies have to be converted into a budget. So budget is used to control, and also budget is closely associated with responsibility accounting. Now, I remember working for some construction companies. At the end of the budget meetings, it may be a profit center. The profit center head will be given a particular budget. This is your top line, this is your cost, this is your bottom line. So in other words, what is happening is the responsibility for that particular performance is fixed on that guy. If he is going to exceed, apart from salaries, he is going to get a bonus. If he is not going to achieve that one, then he has to offer a credible explanation. That's how the budgets are used. Now, my philosophy as far as budgeting is concerned is, if I am the managing director and if you are a profit center head, I should never like to push my numbers into you. Ultimately, I can have a discussion with you, but the number should come from the profit center head, and only if it comes from the profit center head, I may ask you to increase the number. I may tell you why you are underplaying. You can achieve 20% more. But ultimately, if you agree and if you give that number, then you will have a better ownership. The company will get benefited. Then this is another interesting area, variance analysis. In your syllabus, the focus is more on the mix variance and the yield variance. Okay, now just a simple example, the variance analysis is, let's take a soap manufacturing company. Hindustan Lever, they are producing soaps. Now, if you are working in a cost accounting department or management accounting department, you may come out with the information that there has been some $1 million which has been consumed more on the material front. Okay, so there is an adverse variance of 1 million in the material. Obviously, you would like to further investigate what this 1 million is all about. Because if you remember, every product has a certain cost sheet. When I say cost sheet is made up of two things. These are the various raw materials. Suppose if you are manufacturing a soap, probably you may have to use a fatty acid, you may have to use some perfume, you may have to use some 2 or 3 chemicals. All these things are put together, and then the production process, when it is completed, it comes in the form of a soap cake. So you have a certain amount of certain standard price for each of these raw materials. Fatty acid is at $20 per ton. Then perfume will be at this price. So it's not only price for each individual raw material, there is also the quantity which needs to be consumed. So the big picture level is the variance can be, the negative variance can be, your purchase manager might have bought these raw materials in the last period at a price higher than the standard price. Then it is obviously called as you ascertain and you ascribe that negative variance to price. The other thing is your production manager might have been careless. He might have used higher quantity to get that kind of soap production. So it is then called as usage variance. Then there is something called yield variance, mix variance. We will dwell all that in detail in chapter 15. Then I talked about divisional performance measurement system. How do we do that? How do we create a division? Why it has to be done? We will see in detail. Transfer pricing is another very important aspect. And what is the purposes of transfer pricing? And what are the calculations which are done in transfer pricing and how it impacts on the divisional performance? As I said, there are various methods are there. The controlled, comparable, uncontrolled price method is something called market-based price. Full cost or marginal cost, and marginal cost with a markup. You can use different methods. I'm not going to go into the methods right now. We'll talk about it as we reach there. There is also one particular thing why market-based transfer price is advised. I want to just give you one example, because transfer pricing is also very important. 2 things I want to tell you here at a very macro level. Why transfer pricing is very important in international situations. I'm sure you are aware that the world is divided into various tax zones, tax territories. Some may be at 40%, some may be at 30%. Some Gulf countries are at 0% income tax. Now, these companies, multinational companies who are having operations in all these geographical locations, they may try to fool around by using some kind of a pricing technique so that they push the maximum profit to a 0 tax zone or no tax zone. That is why, if you see the point number 3, a market-based transfer price is much more better or advisable to make sure the market-based transfer price. The other word for that is something called arm's length price. So arm's length price is something, if I go to the market, I don't know that particular shopkeeper, he's not my relative nor my friend. I ask him to, I inquire the price of one of the product which is there in his showroom. So he gives a price. That particular price is a market-based price. But I'm going to give you an example. Now, I worked in a company where that automobile company used to manufacture power steering gears for passenger cars, and they also had in a different location, they had power steering gears for heavy vehicles. That means it is fitted in buses and also it is fitted in big lorries. So for power steering gears, one is power steering gears, but these power steering gears also operates, you have to fit that power steering gear with a pump. Unless you have a hydraulic pump, these power steering gears will not function. So this company had a system where they were selling the power steering gears to the external customers. When you sell to external customers, obviously there's no problem. The problem started is they had a pump division. That means they had 3 divisions. One is pump divisions, and the other one is power steering gear manufactured and supplied to OEM car manufacturers, power steering manufactured and supplied to truck and bus manufacturers. So there are 3 divisions. Now, the second and third, whenever the power steering is manufactured and given to the external customers, they only deal with external customers. But you know what? The pump division, who are the customers? They have only two customers. One customer is someone internally sitting who is producing power steering gears for their passenger cars. The other one is selling it for heavy trucks and buses. Now, obviously, the transfer pricing issue will come. Should the pump division transfer at a cost price to these two divisions, or they should have a markup? Because when you ask that pump division to transfer at cost, the guys who are working in pump division will not have any motivation at all. Because what is their profit at the end of the day? It is only zero. Yeah, I agree, they don't sell anything to the outside customer. These type of issues will come in a transfer pricing, which we will talk at length. Then we have something called how do we manage the performance in a very strategic way. There are some frameworks like Fitzgerald, Moon. I'm not going to talk about that, but all that I want to tell you is in this particular chapter 18, this balanced scorecard is again a heavily covered area. I just want to give you a brief idea about balanced scorecard. But do you have any idea what is a balanced scorecard?
No, sir, not really. We've not done it.
Okay. Balanced scorecard. Traditionally, if you are a managing director sitting in a company 15 years back, you will call your finance manager and then you will ask him, hey, come, bring me the P&L account. I want to see what happened until June 2021. So here, what is that you are doing? You think that only the revenues, cost and profit are the important parameters on which you are going to control the company. But in balanced scorecard, there are 4 dimensions. There is nothing wrong in looking at the profit and loss account of the company. But if you only look at the profit and loss account of the company, you are missing on 3 more things. That's what the balanced scorecard is saying. Balanced scorecard gives you 4 dimensions. One dimension is looking at your profit and loss account and then see whether you are going in the right direction. You can compare it with the budget, you can do a variance analysis, all those things are. Now I am going to give you briefly what is the second dimension, what is the third dimension, and what is the fourth dimension. Number 2 dimension is, first focus is on the P&L focus. The second focus is customer focus. Customer focus, why should I do all these things? Okay, you may be a tire manufacturing company. Let's assume you are working in Seat tires. In customer focus, the managing director today who follows balanced scorecard would like to ask, what is the percentage of defective tires returned by the customers? Okay, somebody will come and say, every 1,000 customers, 10 of them are going to complain. Now, this is something which gives you a message. That means you are producing a tire, 1,000 customers take the tire and 10 come back and then say there is a defective. Now, can you reduce that 10 to 1? If not 0, that is something where you have to focus. Then the second matrix in customer focus is, there's something called repeat customer. What is that repeat customer? Oh, last month was June. There was a customer who came in the month of April, and the same customer came and bought same item in the month of June. Is it a very important information? Why these informations are required? I can look at the P&L focus. My profit is so much, sales is so much, I'm 30% more than last year. These are traditional way of looking at the performance. See, if you have a repeat customer, it tells you a story. That means he bought from you for the first time in the month of April. Why did he come again in the month of June when there is another requirement? Why did he not go to your competitor? That means the story is, whatever he experienced by the first purchase, he has been satisfied. Only because he is satisfied, he comes in the month of June. When he came in the month of June, if you have taken care of him properly, whether on the quality or price, X, Y, Z, he may again come in August. So this is all customer focus. Okay, what is the third focus in balanced scorecard? Is it enough if you have a P&L? Okay, I also have customer focus. That is not enough. What is the third focus? Third focus is employee focus. How you are taking care of your employees? Are you taking care of them monetarily? Are you focused only on company's growth at the cost of employees' growth? Or you are such a company where you want the company also to grow and you also want the employee to grow? Remember one thing, there may be employees who are ready to work in your company at 20% less salary than another job which they may get. But as long as you take care of them, you give them enough opportunity to grow in their career, they will work for the company. So this thing is all about whether you have a training calendar for the employee. There are some companies which make it compulsory. Whatever you do, you can be busy on all 365 days. I don't care. There should be minimum 14 working days that guy has to go for training. What does a training means? Okay, today I know something. Suppose if I go for a training, probably my level of knowledge is going to increase. Depending upon which department I work, what are the skill sets which I already have, what are the skill sets if it is added to that existing skill set, which will be much better. These things are done. Okay, we talked about P&L focus, we talked about customer focus, we talked about employee focus. What is the last focus in balanced scorecard? The balanced scorecard also wants you to give some information about the processes and the performance of your factory. That means processes means there is a particular lathe. This lathe, did it work for 80% of the capacity, or did the processes what is followed is much better than your competitors? Ultimately, what is going to happen is the processes and the idle time, how efficiently the machineries are working in the factory, all these things are also important. So, as I said, balanced scorecard has a 4 dimension. It has got a P&L focus. Not only P&L focuses, 3 more new things are added. One is customer focus, employee, how they are satisfied within the company, that focus, and process oriented focus. These are certain things we will deal little bit more in detail in chapter 18. Then there's something called cost management and environmental accounting. We talk about the quality cost, environmental cost, etc. And finally, when we come to chapter 20, you definitely need to know some new trends in strategic management accounting. Who are all the different people who are using management accounting? We already talked about theory of constraints, customer profitability. Many customers, many companies, 80% of their revenue are derived from 5 customers. The remaining revenues are derived from so many thousand customers. So obviously you want to focus on the big customers, and then you want to do a profitability at the customer level. So how the internet and technology has changed the management accounting functions. These are certain aspects which you will see in the last chapter. So with this, I want to finish this overview. Tomorrow onwards, we will be starting on the individual lessons, and obviously tomorrow we'll be focusing on the chapter 1. So Saravanan